Welcome back to Turning Hard Times into Good Times. I'm your host, Jay Taylor, and I'm really pleased to have with me once again Alasdair Macleod. And most of my regular listeners will be familiar with Alasdair, but for those of you who may not be familiar with him, he has a background as a stockbroker, a banker, and an economist, and he is a senior fellow at the Gold Money Foundation. His weekly articles, which I highly recommend, they're written for Gold Money. They're posted on his blog at goldmoney.com, goldmoney.com. Alasdair, thank you for joining me again.
That's my pleasure, Jay.
Always good to talk to you. We've titled today's show, Investing in 2016, Should We Give Up on Gold? Now, I would be surprised if you told us that we should give up on gold, so perhaps I should phrase the question for you as follows. Will 2016 be a year when you would be wise to accumulate gold as it gets cheaper and cheaper as the year goes on? Or will 2016 be a year when it will start to get more expensive in U.S. dollar terms to accumulate the yellow metal?
Well, I got two answers to this. The first, I'll draw on my experience as a stockbroker. And that is, I always found that at the beginning of the year, the majority of people's predictions were entirely wrong. And if the whole world is saying, forget gold, they're far more interesting things, then I'm extremely happy. So that's my first comment. The second comment I would make is that with gold having drifted off, if you take into account the massive expansion of the quantity of broad money, both credit and narrow currency since the Lehman crisis, and indeed over the years, gold is cheaper now than it has ever been against the world's reserve currency, the dollar, with the single exception of the time when it was so underpriced that the US government was forced to scrap its peg at $35 and abandon the Bretton Woods Agreement. Now that's a very, very important statement. Oh. And I think the second thing I would say about the value of it is, compared with the situation at the time of the Lehman crisis, gold is significantly cheaper today. And that's wholly at odds with the continuing systemic risks of fiat currencies from the undercapitalized banking system, who are completely unprepared, I think, for the prospects of markets normalizing. What I mean by that is that the wild overvaluations in bonds and equities in particular, I think, are likely to throw up big losses on the banks' balance sheets, particularly on the Eurozone banks. And also, the other thing is that there are huge commodity loan losses in the system, which the banks are trying to avoid. And I think the overall situation is fascinating because 2015, I would say, is the year of the start of, if you like, an economic and financial crisis. I don't want to over-egg it, but basically, when they boost the economy by lowering interest rates, generally what happens is that they stimulate an awful lot of malinvestment. And there comes a point, usually interest rates rising creates that point, but there comes a point where the whole thing falls over and you get a sort of a washout in the economy. I think that we have seen the beginning of that on a global basis in 2015, and if I'm right, it's going to continue into the first half of 2016. Now that's very, very important because the Fed has just raised interest rates in the States for reasons which I completely understand, but it ignores the international position, which it has actually made considerably worse. So we're at a fascinating juncture, and I think that this is going to end up with the major central banks having to produce a lot of extra currency, if only to counteract contracting bank credit. But as that currency is increased, it's increased on top of what they already produced to rescue the world from the Lehman crisis. Mm-hmm. So it's hard for me to visualize that second tranche of money printing not actually undermining the purchasing power of the fiat currencies. So briefly, the answer to your question is I think that gold is in for a very good year in 2016.
Well, but does it stand to reason, though, Alasdair, that because you might have a financial crisis, that gold would do particularly well? I mean, it's certainly the likes of Lawrence Summers and others are very well aware that gold must not be allowed to be seen as being better than the dollar, right?
That's very true, and certainly since the Lehman crisis, I think there's been a two-pronged approach by the Fed and its partner central banks. I think the one is to improve confidence in the currency and the currencies and the financial system, but at the same time try and persuade everybody that any alternative is not as good as staying with the status quo. And of course that does mean from time to time suppressing the price of gold. And I think anyone who follows the market is aware that that does happen from time to time. You've only got to look at the volumes, the moves, the very definite moves in the market where someone hits the market with the objective of taking any steam out of it. I mean, selling very, very badly. It's as simple as that. And that's not done by someone who's actually trying to make money. It's done by someone who's trying to manipulate the market. Now, whether it's, if you like, a major bank as proxy for the Fed or for the Exchange Stabilization Fund, or whether it's the Exchange Stabilization Fund stroke the Fed, it really doesn't matter. It amounts to the same thing. So I think you're right to make this point, because as the situation deteriorates, we will see attempts, I think, from the central banks to try and clobber the gold price, or at least try and ensure that the ordinary person doesn't get too enthusiastic about it. Because apart from anything else, the physical bullion has more or less all gone to China, India, and places like that, and the vaults in the West has essentially been emptied. And it's a very interesting point, because when all this is washed out, what are the central banks going to say about the gold they have said they own and in fact they don't have? I mean, this is going to be the most extraordinary post-mortem. Whether it'll ever come to light or not, we don't know.
I was going to ask you what would cause these central banks to own up to the fact that they don't actually own the gold.
I think the only thing that would would cause it is if we have a complete systemic reset, and the world begins to understand that the old central banking system has actually completely failed. Then I think it might come out in the open, but not until.
Alasdair, we've had David Jensen on this show, who I know, I'm quite sure you know him. He maintains, and I think lots of other people, and I think you would probably be in agreement as well, that the way the gold price is maintained is through the paper markets, right? And the physical, as you just pointed out, has been going to China and India, and I think from what I read that the Russians have been picking up a lot of the Chinese gold and swapping their oil for gold. What is that what's going on? It's the paper markets that are smashing the dollar quoted price of gold down?
Yes, it's precisely that. When you haven't got any of the physical stuff, what you do is you create artificial supply to suppress the price. And, the Fed can print as many contracts, or indeed the large bullion banks acting on its behalf can print as many gold contracts on COMEX as it wants. It's not in the business of trying to make a profit on its deals. It's in the business of trying to manage a price, manipulate a price, suppress a price. Mm-hmm. And they're doing it at the taxpayer's expense, effectively. So who cares about the cost, the loss? That's not the problem. That's not what they're interested in. What they're interested in is a strategic result.
And the strategic result, of course, is keeping people disinterested in gold, actual, real asset-based money, so that they can keep creating their own inventory of money, if you will, out of thin air, right? And they can keep redistributing wealth from those that create it into their own pockets.
I couldn't put it better myself. In fact, right. I think independently of what you've just said, I have said more or less those words. So I'd agree entirely. Yeah,
it's just a fraud. It is a monetary fraud that is being perpetrated, and the American people very few Americans or people around the world, I think, have a clue about it, but then they don't really understand money either, that money is created out of nothing, and that the dollars they have in their pocket is just, really nothing tangible at all, right?
Absolutely right. Not one person in 10,000 actually understands what money is. and how it comes into existence. I think 1 in a million doesn't even understand that banks create money out of thin air. I mean, I even know economists who don't actually understand that point. So,
No.
it is a difficult subject, I think, for the layman to grasp. Though for people like you and I, Jay, who've spent a lot of time thinking about this, it's actually not a very difficult subject. But I think coming back to your basic point, it is very important as far as the Fed and the governments are concerned. I mean, all central banks, if you like, issuing central banks, that people don't understand what's happening to money because they want to keep the facility to manipulate the value of people's money to whatever ends they deem to be in the public interest.
Yeah, well, it certainly would seem to me if we had an honest educational system, all economics 101 courses would teach that, would teach the basis of fractional reserve banking and how that multiplies the money supply through the system and why fractional reserve banking, never mind fiat money, is really a fraud. But anyway, we're talking about things that I think are really immoral, the immorality of fiat money, which is really legalized theft. But we have to live with that system, Alasdair, because that's what we're given. Ron Paul and others have tried to educate people, but we're swimming against the stream, as it were. So that being the case, where do we go in 2016? I mean, equity markets, I think the equity markets have not been, in the U.S., have not been really as strong as they appeared to have been based on the major indices in 2015. But we've had this massive creation of money, this fiat money we've just been talking about, out of thin air since the Lehman banking crisis, 2008, 2009. And yet we're seeing the real economy stagger, and I would argue even perhaps never really having fully gained much of any kind of growth since 2008, 2009. Despite the fact that we've had this massive amount of money creation, we've seen commodity prices in decline. How do you explain that?
Well, it's slightly two separate subjects. The first thing about the printing of money, and you expressed one side of it, and that is you get trillions of dollars which you create out of thin air. Surely it benefits the economy. Well, the problem is that the argument is only looking at one side of it. Where does the money actually come from? The money comes from everybody, basically, who either has savings or earns money and they can't raise their earnings. People like the pensioners, the people who are disadvantaged in life and cannot respond. It is a fact they are being taxed to produce this, the trillion or two or three of dollars to stimulate the economy. So what you've got is this ridiculous situation where they're trying to stimulate the economy by impoverishing 90% of the people. Oh. Is that going to work? No. I mean, what you can do maybe is on a very, very short-term basis, kid the markets into some sort of extra production. But you're not going to do any more than that. And as a policy, as a continual policy, it is a complete failure. And history shows it's a complete failure. So why on earth they continue with it it is actually beyond reason. I know why they do it. They do it basically because, A, they've got nothing else to do. They've got into the situation where they've got no other mechanism, if you like, of trying to improve the economy. But they don't even understand how to improve the economy. I don't think they even understand really what the economy is. The economy is a free market system where people transact with each other on prices which they agree between buyer and seller. And if you're going to interfere with that process, you're not going to improve on it. I mean, if the state decides that it's going to start telling us all 3,000 major products have got to be made in a certain quantity and sold at a certain price and so on. I mean, that's communism. It just falls apart. So the whole system, basically, I'm afraid, is heading towards some sort of disaster because free markets will reassert themselves. And that is very, very important to understand. And in this sense, there is actually no difference. If you look at Europe between, let's say, European socialism and communism, except in degree. Communism was total. European socialism is part communism, if you like. I defy anyone to come up with a rationale, in economic theory terms, a rational difference between communism and socialism. Where is the break point? There isn't a break point. It's just a matter of degree.
Yeah, and why in the world do we call ourselves a capitalist country in the United States? It's because people don't really understand capitalism and free markets, as you suggest. Well, let me ask you this, Alasdair, why do you think the Fed raised rates? Do they really believe the economy is strong enough, that the demand side of the economy is growing enough that it justifies raising rates? Or might there have been some other reasons why the Fed? Is it a matter of trying to save face? Is it a matter of trying to have some tools in the toolkit, as they say? Why do you think they raised rates now? Because it seems that they raised rates at a time when, if anything, the economy is getting weaker rather than stronger.
Yeah, I think that's right. I also think that the Fed does actually understand that the economy is not as strong as the official statistics suggest. I mean, we get all sorts of reports, sort of business-oriented reports, as opposed to government statistics, which quite clearly show that the US economy isn't really going anywhere in a hurry. I think what they're looking at is two things. I think, first of all, they see that there is demand for money in the US economy. It's going into motor cars, it's going into those sort of what an economist might call capital goods. But basically, it's the expansion of credit for buying motors, for mortgages, for houses, and so on. So you are getting that demand. So they see that the economy, while it's not really bubbling, actually is running along at some sort of base level. I think from that point, the real concern, and I would certainly have this concern, I think, if I was a member of the FOMC, is that we have seen a very substantial fall in commodity prices, particularly energy costs. Now, at some stage, that is going to stop. And not only will it stop, but those prices will probably start going the other way. So if you suspect that your worst enemy is going to be a weak dollar, then what you have to do is to bring about an interest rate policy that will support the dollar and anticipate, if you like, those very nice numbers, energy numbers, dropping out of the back end of the statistic in a year's time, and suddenly you find you got 3 or 4% inflation. I think that is I think they're looking forward to that potential problem, and they want to anticipate it. They want to show the markets that they are anticipating these things and on top of the curve. And I think that to my mind is the rationale. But of course, the rest of the world is going to hell in a handcart because commodity prices have collapsed, demand has collapsed. I mean, only today we saw that the Baltic Dry Index has fallen to a new record low, which for your listeners basically tells us that nobody is employing ships to to transport things around the world. It is a sign of collapsing trade, in effect. And this is something which is going on outside America. And one of the big problems is that the stronger the dollar is, the worse the situation is for countries and companies, international companies, who have borrowed in dollars and have to pay for the privilege, if you like, out of local currencies. So I think a lot of the dollar strength is being brought about by money from countries like Brazil, Australia, these commodity-producing countries needing to cover dollar obligations, realizing that the dollar is going up. Their income has gone down because commodities are not selling for what they used to, and they've got themselves into a real problem. And we see this with the ratings on countries like Brazil. I mean, they're just getting, downrated and downrated the whole time. And we've seen this with companies like Glencore, who have had to really cut back on everything. Even Anglo American. A sort of conservatively run mining finance house, they've had to lay off something like 80,000 people worldwide. Right. So you have got the potential. If these are the blue chips suffering, then imagine what's going on down the pile. And I think the potential dollar-related commodity losses are probably in the range of $4, 5, maybe $6 trillion.
Yeah.
And this is enormous. And of course, it is a problem for the banking system.
Right. Well, Alasdair, with just less than 2 minutes left here yet,
yep.
Jim Rickards, I saw him talking yesterday, I guess it was, talking about helicopter money. You know, it was Ben Bernanke talked about helicopter money. He's suggesting that we're likely to see some stimulus coming along now with the House Majority Leader Ryan agreeing to a budget deal that was all kinds of massive amounts of money, deficit spending coming into play to stimulate the economy, through fiscal means. Do you see that as a possibility heading into 2016? And if so, might that end up in a weaker dollar and what you're talking about, a rise in inflation and possibly a bit more bullish scenario for gold and other commodities?
Well, I think almost on the basis that monetary policy has failed completely, they could well try fiscal policy. But I think they'll be looking at a situation where the budget deficit looks like it's going to be increasing anyway. I mean, we're coming into an election year, one. And secondly, if the rest of the world is, as I said earlier, going to hell in a handcart, then I really just don't see the budget deficit coming down in the United States. I think it is likely to remain pretty high. So the room for fiscal stimulus is somewhat limited. Though having said that, I think a lot of the Keynesian economists would very strongly recommend fiscal stimulus.
Right, and what happens though if the banks, if this economy continues to head downward, and then we start to see a turnaround, the Fed all of a sudden has to start printing, going to QE4 or so. What would that do for gold? And we're just in 10 seconds.
I think it would obviously be good for gold, but what I think you have to look for, Jay, is the purchasing power of the dollar. That can go down simply because people move their preference away from holding dollars towards holding goods. And it doesn't take much of a shift in the hands of the general public to have a massive effect on the purchasing power of the dollar.
Oh, yeah, so indeed. Indeed, a change in the velocity of money. Thank you very much. We are out of time. Thank you very much, Alasdair, for your thoughts, and always appreciated. Thanks for coming on. We'd look to do it again sometime very soon.
My pleasure. My pleasure.